Hi everyone. Today we're going to talk about Chapter 3, the financial environment. We have already talked about Chapter 2, the economic environment, and how the economic environment can affect our business decisions. Now the question is how the financial environment can affect the decisions of our business. So we're going to look in this chapter and explain the role of financial intermediaries. And also we're going to look at the financial markets, how these financial markets can help our business to raise long-term finance through the use of the capital markets, and how they can help our business to raise short-term finance through the use of the money markets. And finally, we're going to say a few words about the international markets, which organizations have the opportunity to use international markets so as to raise finance. So let's start from the very beginning. Let's explain a bit about what is the role of the financial intermediaries. So financial intermediaries are organizations which bring together potential lenders and potential borrowers. So financial intermediaries obtain deposits from lenders and then relend them to borrowers. This is what financial institutions do, banking institutions do. They bring potential lenders together with potential borrowers. So examples of financial intermediaries are the commercial clearing banks, the building societies, institutional investors such as insurance companies, investment and unit trusts, pension funds. If you think about it, these organizations, they accumulate the funds of individuals, and these funds are invested to other organizations. Finance companies, which provide business and domestic credit, leasing finance, factoring, and so on. So all these organizations facilitate this bringing together of potential lenders and potential borrowers. Now, what are the benefits which are provided by financial intermediaries? Now, benefit number one is called aggregation. Now, what's aggregation? Financial intermediaries can accumulate small deposits which can be lent to large borrowers. So this can help to meet the demands of the large borrowers. So for example, you have a borrower who needs $1 million, but you might not have a depositor who has $1 million, but you might have a good number of depositors that they have deposited much less amounts of money in their deposit accounts. So the financial institution can accumulate all these small deposits, and this will allow the financial institution to lend a larger amount of money to these borrowers. Now, another benefit is called maturity transformation. Now, what does this mean? It means that you might have depositors that they have deposited their money only for a short period of time, but this will allow financial institutions to lend the money for a long period of time. So this, of course, could facilitate again both borrowers and lenders. And another benefit that they provide is what is called risk transformation. Now, what does this mean? It means that the lenders are not exposed to the same risk if they were lending their money directly to the borrowers, since now there is the middleman, the financial intermediaries. So this reduces their risk exposure. Other benefits which that the financial intermediary could provide, of course, is that it can offer certain hedging techniques to organizations, and therefore reducing the foreign currency risk that they are exposed, and also can offer a higher liquid market and more flexible market to both lenders and borrowers. You need to remember this terminology: aggregation, maturity, transformation, risk transformation, because sometimes they do come up in the examination. Now let's look at the financial markets. Now we have, of course, the capital markets and the money markets. Okay, Capital markets are the markets that a business can use so as to raise long-term finance. And actually we're talking about stock exchange here. All right, now there is the primary market, which of course this gives opportunity to a business to sell new shares and to raise new funds. It could be shares, it could be bonds as well. And we have also the secondary market, and of course in this case the business doesn't raise any new funds. It's just the secondary market provides the trading of existing financial instruments. For example, if you have one shareholder who wants to sell his shares to another prospective investor, this of course will be facilitated through the stock exchange, but this will not raise any new funding to our business. Alright, so this is the secondary market. The primary market, as I explained earlier, is that if we have a business that wants to raise additional funding, it addresses this issue to the public and it can sell its shares or bonds, and this will allow the business to raise additional funding. Okay? Now, there are two main capital markets in UK, the London Stock Exchange and the alternative investment market. The benefit of the alternative investment market is that it has fewer regulations and it costs less for a company to become listed in the stock exchange, and therefore its shares can be traded compared with the London Stock Exchange. So there are less regulations. It's much easier for these organizations to enter, to be listed in this alternative investment market compared with the London Stock Exchange. Now, these capital markets, of course, are used to allow our business to raise long-term finance. Okay? Now, except from the capital markets, of course, a business can use money markets, and money markets will allow our business to raise short-term financial instruments are traded in these money markets, and of course this will allow our business to raise short-term funding, short-term borrowing and short-term lending. So the role of the money market is to provide short-term liquidity to industry and the public sector, to provide short-term trade finance, and to allow an organization to manage its exposure to foreign currency risk and interest rate risk. We have already seen this in our chapters 20 and 21. We use the money market hedge to protect our business from unfavorable exchange rate movements, and we use the FRAs, the forward rate agreements, to protect our business for unfavorable interest rate movements. So these are if you like, options that are available to companies by using the money markets. Now, there are certain money market instruments. Of course, you can realize when you read the word money market, we're talking about short-term deposits or short-term borrowings, all right, which are available to companies. Now, these money market instruments can be negotiable, in other words, traded, or non-negotiable, and can be divided into three categories. So we have the interest coupon bearing instruments. Now, what does this mean? It means that these are issued at traded face value, and the investor receives face value plus interest and maturity. So for example, if the face value is 100, at maturity is going to get interest, let's say 5%, another $5, so the investor will get $105. So it's going to be the face value plus the interest. And there are a number of interest-bearing instruments which are available, and these are the money market deposits, certificates of deposit, and repurchase agreements. So I have written I have given some more information below about the money market deposits, certificates of deposits, and repos, as we call them, the repurchase agreements. Please read them and get a brief understanding with what each one of those states. Now, another if you like, money market instrument which is available are what we call the discount instruments. Now here, what happens is that we do not pay interest, and these money market instruments are issued at a discount, to the face value. So the discount is equivalent to the interest paid to the investor and is the difference between the purchase price of the instrument and the price of maturity. So for example, imagine that these are issued at 90. So we offer an interest of 10. So finally, the investor will receive 100. So the 100 is the face value, but because this face value is discounted, so it's issued at the price below. So now in my example here, this is 90. So 90 plus the 10, finally the investor will get the 100. In other words, he would be compensated with the return of 10, and this will be the interest that he will enjoy. So he gets he pays a discounted price and he receives the face value. Okay, and again here there are a number of instruments available. All right, so we have the treasury bills, we have the commercial paper, and we have the banker's acceptance. Again, please read the small descriptions which I have provided, just to give you a brief understanding, which give you a bit understanding of what you need to be aware of in respect of each of these discount instruments. And finally, we have the derivatives. Now, what do we mean by derivatives? These are financial products whose values come from the value of an underlying asset. In other words, the value of this financial product is determined by the value of another type of asset. And of course, these are the forwards, the futures, the options, and the swaps. We did mention them during the delivery of chapter 12 in respect of foreign currency, some of them at least. Okay, so be aware what are these derivatives, all right? Which are these financial products? So we have the forward, a future, we explained this, an option, a swap, all right? And of course, you need to be aware of some basic information in respect of these products. Now, except from the money markets, large organizations can have access to international money and capital markets. All right. Now, what do we mean by international money and capital markets? We mean, when we say international money, we mean euro currency markets, and when we say capital markets, we mean Eurobond markets. The word euro doesn't have anything to do with the currency of euro. All right. What euro means is that the borrowing or depositing takes place in a currency other than the currency of the country which our business operates. So for example, let's look at the euro currency. You see, since it's a euro currency market, we mean here that our business has the ability to deposit or borrow in short term. Okay? So a UK company, instead of borrowing in sterling, it might also borrow in a foreign currency. And of course, this is called euro currency loan. And as I already mentioned, these are only for a short period of time. All right. So the euro currency markets involve the deposit of funds with a bank outside the country of the currency in which the funds are denominated, and relending these funds at a short period of time. That's why I said that euro currency markets actually they give access to short-term funding or borrowing to businesses. But you have to realize that these markets are available only for large companies. All right. So, for example, if a UK company borrows $100,000 from its bank, this is called euro-dollar loan. As I said again, it doesn't have anything to do with the euro. It just indicates that the borrowing takes place in a currency other than the local currency. So in this case, the local currency is the sterling pound. This business has borrowed in dollars, so this loan is called euro-dollar loan. Now, except from the euro currency markets, larger organizations have access to international capital markets. Now, since you can see here the word capital markets, we are talking about the ability of these organizations to deposit or to borrow long term. Okay, long term. So only well-established businesses with high credit ratings can have access to this type of markets. Okay, so allows very large companies to borrow directly from investors in a foreign currency. Again, because the word here is euro bond, let us say, that means that this borrowing takes place in a currency other than the currency of the country in which our business operates. So a Eurobond is a long-term loan raised by large companies denominated in a currency which often differs from that of the country of issue. Alright, and Eurobonds, as again I already explained, may be suitable source of finance for large organizations with an excellent rating. Alright, so that's about chapter 2. Have in mind, one multiple choice question can appear asking you about the most popular area, of course, is the one that I have explained earlier, and of course it relates to the benefits provided by the financial intermediaries. And the other, if you like, popular area is to be able to explain a money market instrument. And of course, have in mind the three categories: the interest coupon bearing instruments, the discount instruments, and of course the derivatives. Please do not hesitate to call me if you have any queries. Bye.